Act 1. The machine breaks the hook. The Tokyo butterfly effect. Listen closely. You are witnessing the exact moment the world changed. We are inside a sterile, soundproof boardroom at the Bank of Japan. 9 people sit around a table. There are no sirens, no alarms, no screaming traders, just a clinical, unanimous 9-0 vote. At precisely 12:42 p.m., these 9 individuals moved a decimal point. They raised the benchmark interest rate to 0.75%. On paper, it's a rounding error. In reality, it is the trigger for a global margin call. This is the Tokyo butterfly effect. A technocratic tremor in a single Tokyo zip code has just sent a Category 5 tornado ripping through Wall Street. By the time the closing bell rings in New York, $54 trillion in global wealth has been incinerated. Nikkei, down 12.4%. One day. The most violent vertical drop since '87. Total incineration. But this isn't just a bad day for the stock market. This is something much more sinister. This is a glitch in the very physics of money. In our last dossier, the Empty Tower Crisis, we showed you how high interest rates are crushing commercial real estate. But that was just the symptom. Today, we are exposing the cause. Stop for a second. Ask yourself, why did your retirement portfolio just lose 10% of its value when the US economy is supposedly fine? Why is your local bank suddenly tightening its belt? To find the answer, we have to look at the smoking gun of the 2025 crisis, the bear steepening anomaly. Look at the evidence. On December 10th, the US Federal Reserve did exactly what they promised. They cut interest rates to 3.5% to save the economy. Usually, that makes mortgages cheaper. Usually, that makes your life easier. But 9 days later, the Tokyo butterfly flapped its wings. Suddenly, the math broke. Despite the Fed's rate cut, USP mortgage rates didn't fall. They spiked. Long-term Treasury yields shot up to 4.14%. Your 3-0-year fixed mortgage, it's now stubbornly stuck at 6.3%. The Federal Reserve has lost control of the long end of the curve. The yield anchor that held the world steady for 30 years has been ripped out of the seabed. The silent assassin has arrived. This isn't just a policy change. It's a structural dismantling of the global financial order. Japan, the world's largest creditor, is finally calling its money home. And if you think you're safe because you don't own Japanese stocks, think again. Today we are opening the case file on the most dangerous trade in history. We are deconstructing the heist of the century, the $3 trillion carry trade unwind. We are going to show you how a quiet decision in Nihonbashi is currently freezing the American housing market, and why your local bank is sitting on a $160 billion time bomb. Buckle up. This is Macro Untold. Chapter 1. The Macro Thesis. To understand the crime, we have to go back to the beginning. We have to look at the financial interregnum. For 30 years, from 1995 to 2025, the world lived in a state of monetary suspension. While you were buying your first house, or starting your career, or investing in the miracle of the Nasdaq, you were living in a dream world subsidized by a single country, Japan. After their own asset bubble burst in the early 90s, Japan pioneered something called the architecture of repression. They were the first to hit the zero bound. They kept interest rates at zero or even negative for decades. But Japan wasn't just sitting still. they were exporting their savings because Japanese households and massive whale banks like Norinchukin couldn't get a return at home. They became the world's lender of last resort. They didn't send bailouts, they sent liquidity. Trillions of yen flowing like blood through the veins of the global system. They funded the Australian mines. They bought Brazilian debt. They funded the US corporate buyout market through collateralized loan obligations, or CLOs. Precision matters here. Japan became the largest foreign owner of US debt, holding over $1.1 trillion in treasuries. For 30 years, they were our price-insensitive buyer. They didn't care if the yield was low. They had to buy. This allowed Washington to spend trillions they didn't have, and it allowed you to enjoy some of the lowest mortgage rates in human history. But as of December 19th, that era is dead. The financial interregnum has been replaced by the Great Reversal. Look at your own portfolio. Most of you were told that diversification would save you. If stocks go down, bonds go up, right? Not anymore. We have entered a phase transition in market physics known as the correlation of one. In a carry trade unwind, diversification is a myth. Why? Because when the Bank of Japan raises rates, the people who borrowed that free money get a margin call. They don't sell what is bad, they sell what is liquid. They sell their Bitcoin, they sell their gold. Everything crashes in a synchronized margin call cascade because the cost of the yen they borrowed is suddenly exploding. The math for this collapse is driven by a single number, 2.00%. We call this the event horizon. For decades, Japanese life insurers and pension funds were in zero-yield exile. They were forced to buy US debt just to stay solvent. But once the 10-year Japanese government bond JGB yield breached 2.0% following the December 19th hike, the gravity of the global system reversed. This is the sovereign magnet effect. Think about it. If you are a Japanese bank, why would you pay a 2.5% fee to hedge the currency risk of owning a US bond just to net a pathetic 1.64%? You wouldn't. Now that you can earn a risk-free 2.05% at home in Tokyo, you are calling your money back. Trillions of dollars are currently being sucked out of the US financial system and repatriated to Japan, and that leaves a massive $3 trillion demand vacuum in the US Treasury market. This isn't a theory. It is a mathematical certainty. We are witnessing the end of infinite cheap liquidity. The global liquidity floor has permanently risen. The US no longer has its most loyal, price-insensitive buyer. We now have to compete for capital on a price basis. And that means structurally higher yields and a permanent Japan tax on every loan you ever take again. But here is the question that should keep you up at night. Who are the first people to drown when the liquidity dries up? In our next chapter, we are going to look at the architecture of repression, the free money machine that built this trap in the first place. We're going to expose the $80 trillion blind spot that the world's central banks are desperately trying to hide from you, because the silent assassin isn't done yet. Next, we meet the whale, the bank that bet everything on the carry trade and just reported the largest loss in its 100-year history. Stay with us. This heist is just getting started. Chapter 2: Anatomy of the Free Money Machine. The silent assassin didn't appear overnight. It was built brick by brick, over 30 years of desperation. We call it the free money machine, but in the halls of power it had a more clinical name: yield curve control, or YCC. Imagine a giant water tower looming over the global financial landscape. For decades, the Bank of Japan acted as the lead engineer, pumping an unlimited supply of yen into this tower to keep the pressure, the interest rate, at exactly zero. In September 2016, they solidified this architecture of repression. They committed to buying an unlimited amount of 10-year Japanese government bonds to ensure the yield never moved. This wasn't just a policy. It was a state-sponsored guarantee that borrowing yen would always be free. This transformed the yen into the world's most predictable funding currency. It provided a sovereign put on duration, a psychological backstop that told every hedge fund, bank, and retail trader, "Go ahead, take the leverage. We've got the floor." The machine operated on three distinct pillars. Pillar 1, the funding leg. You borrow yen at the zero bound, interest rates often less than 0.1%. This is your raw material for leverage. In a world of 5% global inflation, getting capital at 0% is a mathematical free lunch. Pillar 2, the spot transaction. You take that borrowed yen and immediately dump it on the market for US dollars. This does something lethal. It devalues the yen. As thousands of traders did this simultaneously, the yen got weaker and weaker. This created a virtuous cycle of profit. The weaker the yen got, the cheaper it was for you to pay back your original loan in dollars. Pillar 3, the investment leg. This is where the money went to work, and where the systemic rot began. The research shows three primary targets for this yen-funded bloodstream. First, US Treasuries. Japan became the largest foreign holder of US debt with over $1.1 trillion in holdings. This suppressed US yields, allowing Washington to fund record deficits on the backs of Japanese savers. Second, the AI and tech nexus. Carry trade liquidity acted as a margin loan for Silicon Valley, fueling the meteoric rise of companies like Nvidia. Third, crypto assets. Bitcoin and Ethereum became high beta proxies for this cheap money, explaining why they often crash the second the yen starts to strengthen. Ask yourself, if this machine was so stable, why is it currently tearing the system apart? Because of the whale. We call this entity the whale. It manages the savings of Japanese farmers, and right now it is bleeding out. But we'll get to the autopsy of that disaster in Chapter 6. First, we need to understand the machine that killed it. The free money machine has turned into a global liquidity vacuum, but the most terrifying part isn't what we can see on the surface. Official statistics tell us the carry trade is roughly $3 trillion. That is the sanitized version. That $3 trillion figure only includes visible on-balance sheet loans. However, the Bank for International Settlements has identified a staggering $80 trillion blind spot. We are talking about the notional value of hidden US dollar debt wrapped in foreign exchange swaps. This is the synthetic leverage that doesn't appear in any traditional audit. This is the real explosive. These are synthetic loans. They don't appear in traditional debt tallies, but non-Japanese banks owe roughly $39 trillion of this hidden yen debt. This market has a churn of $5 trillion every single day. It is the plumbing of the world. And as the Bank of Japan raises the basis spread, the cost of these swaps is exploding. The plumbing is seizing up. The silent assassin is no longer just a Japanese problem. It is the invisible force currently draining the global dash for cash. Chapter 3: The Smoking Gun. What specific economic triggers prompted the Bank of Japan's rate hike? For 30 years they fought a deflationary ghost, but in late 2024 that ghost finally died. By November 2025, core inflation in Japan hit 3.0% and it stayed there for 40 consecutive months. This wasn't just imported inflation from energy costs. It had mutated into demand pull inflation. The Japanese consumer, after decades of hibernation, was finally spending. The definitive detonator was the shunto, the annual spring wage negotiations. In 2024 and 2025, Japanese workers secured wage hikes of 5.25%, the highest in 33 years. Critically, these hikes weren't just for giants like Toyota. They spread to the small and medium enterprises, the SMEs, where wages rose by 4.65%. Governor Kazuo Ueda had his smoking gun. He couldn't justify near rates when wages were growing at 5%. To stay at zero would be to risk an inflationary meltdown. It wasn't a policy choice anymore. It was then came the politics. In October 2025, Sanae Takaichi was elected as Japan's first female prime minister. She campaigned on aggressive stimulus, a 21.3 trillion yen package to help households struggling with the high cost of living. But she faced a paradox. The weak yen had become a political death trap. It was acting as a tax on every Japanese citizen, making food and fuel too expensive. To save her administration, Takaichi made a fiscal monetary bargain. She would spend the stimulus, but she gave the BOJ the green light to hike rates and defend the currency. It was the Takaichi trade. This is a textbook fiscal monetary pincer. The government is stepping on the gas with stimulus, while the BOJ pulls the emergency brake with rate hikes. They are burning the transmission of the Japanese economy in real time. The final blow landed on December 19, 2025. In a clinical 9-0 vote, the BOJ Policy Board raised the rate to 0.75%, the highest level since 1995. But look at the timing. Just 9 days earlier, on December 10th, the US Federal Reserve had cut rates to a range of 3.5%. The two largest central banks in the world were now moving in opposite directions. The yield differential that made the carry trade profitable didn't just shrink, it collapsed. Once you factor in the 200 basis point cost to hedge the currency risk, the risk-free profit of buying US Treasuries with yen effectively vanishes. The trade turned negative. Think about that. If you were a Japanese billionaire and you could now earn a safe 2.0% at home, would you keep your money in a risky US bond that pays you a net 1.6% after fees? Of course not. You'd bring your money home. And that is exactly what happened. The Great Repatriation began. The triggers are set. The machine is being dismantled. But this isn't just a market correction. We have entered a phased transition in market physics known as the correlation of one. In a carry trade unwind, you don't sell what is bad. You sell what is liquid to cover your yen-denominated margin calls. This is why, on the Black Monday of 2024, the Nikkei dropped 12.4%, and the contagion spread to Wall Street in minutes. This is why Nvidia and Bitcoin, two assets with completely different fundamentals, started moving with a 0.84 correlation. Diversification is a fairy tale when the world's funding currency is on fire. The first domino has fallen. The free money machine is dead. But as that Japanese capital leaves the US, it's leaving a massive trillion-dollar crater in the one market the world depends on for stability. The collateral bedrock of the global system is shaking. Coming up, we go inside the US Treasury market earthquake. We'll show you why the 20-year bond auction failed and why the Federal Reserve has officially lost control of the long end of the curve. The Japan tax is about to hit your mortgage, and it's only getting worse. Stay with us. Act 2 starts now. ACT2, The Contagion, Chapter 4, The Systemic Epicenter, the US Treasury Earthquake. Tokyo has exhaled. Now, Washington is suffocating. The clinical decision made in Nihonbashi didn't stay in Japan. It traveled at the speed of light through the fiber optic cables of the global repo market, heading straight for the collateral bedrock of the world, the US Treasury market. For 30 years, the global financial architecture rested on a single, unshakable foundation: the recycling of Japanese savings into Western debt. It was a subsidy for the American way of life. But as of late December 2025, that foundation hasn't just fractured, it has dissolved. Ask yourself, what happens when the world's most reliable, price-insensitive buyer, the entity that has been funding American deficits for a generation, suddenly walks away from the table? You're about to find out. Welcome to the Great Repatriation. The mechanics, a forensic autopsy of the math. Let's look at the crime scene. We aren't looking for fingerprints. We're looking for yields. Japanese institutional investors, the whales, hold approximately $1.1 trillion in US public debt. They are the largest foreign creditors on planet Earth. For years, they stayed in US markets because domestic Japanese yields were uninvestable. But the silent assassin changed the math. As a forensic investigator, you have to follow the hedged yield. A Japanese life insurer doesn't just buy a US Treasury for the face value yield. They have to hedge the currency risk back to yen. As of late 2025, a 10-year US Treasury yields 4.14%. On the surface, that looks great, but the cost to hedge that dollar exposure back to yen, driven by massive interest rate differentials and basis swap friction, is roughly 2.5%. Do the math with me. 4.14% minus a 2.5% hedging cost leaves a net yield of just 1.64%. Now look at the alternative. Following the December 19 hike, the 10-year Japanese government bond, JGB, has surged to 2.05%. Think about that. If you are a Japanese fund manager, do you take a 1.64% return in a foreign country with massive geopolitical risk? Or do you take a 2.05% risk-free return at home? It's a no-brainer. The 2.0% JGB yield is the event horizon. Once it was breached, the sovereign magnet activated, pulling trillions of dollars back to Tokyo and removing the primary buyer of US debt exactly when American borrowing needs hit historic highs. The impact: the 20-year bond auction failure. The first sign of the structural break appeared in the plumbing. the US Treasury needed to issue record amounts of debt to fund a fiscal deficit of 7% of GDP. But their best friend from Tokyo was nowhere to be found. In late 2025, the Treasury held an auction for 20-year bonds, a maturity that is notoriously illiquid and heavily dependent on foreign whales. The result was a categorical failure. The bid-to-cover ratio, the amount of bids received for every dollar of debt sold, plummeted to 2.46. The historical average is 2.65. Even worse, the auction had a tail of 1.2 basis points. In plain English, demand evaporated at the last second. The Treasury was forced to pay a much higher yield than expected just to clear the supply. This leads us to the most dangerous anomaly of the 2025 cycle, the bear steepener. Usually when the Fed cuts rates to 3.5%, your life gets easier. But the Tokyo butterfly just broke the math. Think of it this way. The Fed is the lead singer, but Japan owns the speakers. On December 10, the Fed dropped the mic and cut rates to 3.5%, but it didn't matter because 5,000 miles away, Japanese banks were dumping their long-dated US Treasuries to raise yen and cover their massive carry trade losses. It is basic market physics. More sellers than buyers means the price of the bond collapses and the yield, the interest rate, spikes. The Fed's knife fell on water because they can't force people to buy what Japan is determined to sell. Write this down. It is the new law of the global epoch. The Fed controls the price of money, but Japan controls the cost of credit. The Federal Reserve can lower the price of short-term loans all day long, but the global supply and demand for collateral is determined by the Japanese savings pool. With the Japanese yield anchor removed, the US market must find a new equilibrium. To attract new price-sensitive buyers like US hedge funds, yields must go higher. This is the Japan tax. Your mortgage rate is decoupling from the Fed. Even as the Fed eases, your cost of home ownership stays stuck at 6.3%. The intended stimulus of the American Central Bank is being neutralized by a withdrawal of capital 5,000 miles away. The softer volatility and the repo clog. But the earthquake didn't stop at mortgages. It hit the heartbeat of the financial system, the repo market. We are seeing softer volatility, spikes in the secured overnight financing rate that we haven't seen since the 2019 liquidity crisis. Why? Because there is a flood of collateral and a scarcity of cash. Relentless US debt issuance is meeting a Japanese sell-off. Primary dealers are facing regulatory constraints like the SLR, the supplemental leverage ratio. They literally do not have the balance sheet room to hold all this debt. The system has lost its shock absorbers. The global plumbing is seizing up. This isn't a theory. It is a structural regime change. The era of exorbitant privilege, where the US could fund its deficits cheaply because of a price-insensitive foreign buyer, is eroding. The US must now compete for capital on a price basis. The silent assassin has moved from the Japanese boardroom to the American suburb. The Great Repatriation is draining the life out of the US housing market and regional banks. But as the liquidity disappears, something even more terrifying is happening. We are entering the correlation of one. The moment when your safe diversification fails and every asset you own starts falling at exactly the same time. Chapter 5: Market Physics. the correlation of one. The Treasury market is the foundation, but the earthquake is moving into the skyscrapers. Everything you've been taught about investing, the 60-40 portfolio, the safety of diversification, the digital gold narrative, is being fed into a wood chipper. We are entering a phase transition in market physics. In the ivory towers of academia, they call it criticality. On the trading floor, they call it the correlation of one. Ask yourself, if everything in your portfolio is falling at the exact same time, your stocks, your bonds, your gold, your crypto, do you actually own a diversified portfolio? Or do you just own different versions of the same leveraged bet? In video 1.2, The Empty Tower Crisis, we showed you how the commercial real estate market collapsed because the anchor of low rates was ripped away. Today, that same anchor is creating a gravity well. As the yen repatriates to Tokyo, it is creating a vacuum that is sucking the liquidity out of every high beta asset on the planet. The concept, diversification dies in the dark. The 2025 crash isn't a credit crisis like 2008, it is a liquidity event. The difference is lethal. In a credit crisis, you sell the toxic assets, the bad mortgages, the failing companies. But in a liquidity event, you don't sell what is bad, you sell what is liquid. When a hedge fund gets a margin call on its yen-denominated debt, they don't have time to wait for a buyer for their illiquid office buildings or their private equity stakes. They need cash now, so they hit the sell button on their most successful, most liquid positions. Modern portfolio theory, MPT, assumes that asset classes move independently. But when the funding currency of the world, the yen, spikes, it becomes the meta factor that links everything together. The market ceases to be a collection of companies and becomes a single, tightly coupled organism. Diversification becomes a myth exactly when you need it most. The proof: the Nvidia Bitcoin nexus. Look at the evidence. The smoking gun of the 2025 collapse is the relationship between Nvidia and Bitcoin. On paper, these assets have nothing in common. One is a semiconductor giant generating $57 billion in record revenue. The other is a decentralized digital asset. But in the gravity well of the yen unwind, fundamentals are irrelevant. In late 2025, the correlation between Nvidia and Bitcoin hit 0.84. They weren't moving on earnings reports or digital gold narratives. They were moving as high beta liquidity proxies. Nvidia reported a staggering 62% annual growth. It didn't matter. Its stock price collapsed in lockstep with a 35% drawdown in Bitcoin. Why? Because they are the two most liquid winners in the global system. When the margin calls came for the yen carry trade, Nvidia and Bitcoin were the ATM machines for the world's over-leveraged funds. The mechanism, the margin call cascade. How does a hike in Tokyo lead to a flash flush on a Sunday night in New York? The mechanism is the margin call cascade. It is a recursive algorithmic feedback loop. Price decline leads to collateral erosion, which triggers a margin call forcing a liquidation, which drives the price down even further. In 2025, the speed of this cascade is dictated by machines. As the yen strengthens, the value of a fund's yen-denominated debt rises relative to its dollar-denominated assets. Prime brokers' algorithms don't ask questions. When net asset value thresholds are breached, the machines trigger automatic sell orders. This reached its terminal velocity during the October 10, 2025 flash flush. It started on October 10 with a single unverified post on X alleging new 100% tariffs on Chinese imports. In a normal market, traders would wait for confirmation, but in this thin liquidity environment, the algorithms didn't wait. They sold. In a thin market where liquidity was already drying up, this was the match in the powder keg. In just 24 hours, $19.1 billion in leveraged positions were wiped out. The market gapped down. This exposed the structural rot in the new financial system, DeFi contagion. Wrapped assets like USD, designed to stay pegged to the dollar, suddenly depegged. USD traded as low as 65 cents on major exchanges. As the peg broke, automated smart contracts triggered even more liquidations, dumping collateral onto a market that had no buyers. Addressing the viewer directly, this is predator trading. Our forensic analysis of the October flush found a single entity that opened a $1.1 billion short position just hours before the crash, netting $150 million in profit. The whales are hunting you. They are using the thin liquidity created by the Japanese exit to trigger these cascades and harvest your stop losses for profit. The open loop diversification is dead. Fundamentals are a memory. The correlation of one has turned the global market into a slaughterhouse. But who is providing the massive volume for these sell-offs? Who are the institutional whales whose distress is actually driving the $19 billion liquidations? Coming up in Chapter 6, we go inside the boardroom of Norinchukin, the CLO whale that just reported the largest loss in its 100-year history. We'll show you how the savings of a Japanese rice farmer became the detonator for the US corporate buyout market. You think the flash flush was bad? Wait until the whale stops breathing. The silent assassin is moving toward its biggest target yet. Stay. You think you're safe because you own Nvidia and Bitcoin? You're about to find out that in a liquidity crash, fundamentals don't matter. Only the margin call does. Stay with us, because we're about to look at the Nvidia Bitcoin nexus and the $19 billion flash flush that proved nobody is safe from the Tokyo butterfly. Stay with us. Act 3 starts now. ACT 3, the victims. We've spent the last half hour talking about boardroom technocrats and abstract market physics. But macroeconomics isn't just lines on a chart. It's a crime scene, and every crime scene has victims. To find our first victim, you have to leave the glass towers of Manhattan and travel 5,000 miles west, past the neon haze of Shinjuku into the quiet, mist-covered rice paddies of rural Japan. He doesn't follow the Federal Reserve. He doesn't know what a bear steepener is. He just wants his retirement savings to be there when he stops working. But right now his life's work is being used as the detonator for a global financial explosion. In our previous investigation, video 1.2, The Empty Tower Crisis, we showed you how high interest rates turned the world's most expensive office buildings into hollowed-out ghosts. Today, we uncover the silent assassin that kept those rates high. Welcome to the autopsy of a whale. Chapter 6. The whale that beached itself. Remember the entity we called the whale. It's time for the forensic autopsy. Officially, its name is Norinchukin Bank. Norinchukin is unique. It isn't a retail bank for the urban elite. It is a central cooperative bank for Japan's agricultural, forestry, and fishery workers. It manages the collective wealth of the people who feed Japan. For decades, the whale was a steady, predictable creature. But then, the Bank of Japan did something radical. They introduced negative interest rate policy, NIRP. Suddenly, the whale was starving. The mistake, the hunt for yield. Because domestic Japanese government bonds, JGBs, offered zero or negative returns, Norinchukin faced a profitability crisis. They couldn't meet the dividend and deposit requirements of their farmers by staying in Japanese waters, so the whale went hunting. It swam into the deep, volatile waters of the West. It became a global lender of last resort, exporting trillions of yen to fund foreign sovereign bonds. At its peak, this single institution sat on a massive portfolio of US Treasuries and European debt. Think about the irony. To pay a pension to a rice farmer in Niigata, a bank in Tokyo had to become the primary financier of the United States government. But in 2022 and 2023, the world changed. Global inflation spiked. Central banks across the West started hiking rates at the fastest pace in 40 years. In the bond market, there is a simple, lethal law. When rates go up, the value of the bonds you already own goes down. Because Norinchukin was holding billions in fixed-rate foreign bonds, the market value of their portfolio didn't just dip, it collapsed. The whale was suddenly sitting on massive, unrealized losses. The bloodbath, a $12 billion hole. By fiscal year 2024, the silent assassin struck. Norinchukin was forced to report a staggering net loss of approximately. The bank suffered a devastating 100-year record loss of $12 billion, a true bloodletting. To avert disaster, the whale didn't just halt purchases. It initiated a massive $63 billion fire sale of foreign sovereign bonds in what became known as the Great Repatriation event. This is our smoking gun. When the world's largest price-insensitive buyer turns into a forced seller, the yield anchor is gone. This is the proof that the shadow banking system is losing its primary source of yen liquidity. This wasn't a panic, it was a strategic retreat. They had to stop holding duration risk, the sensitivity to interest rates, before it killed them. But the whale didn't just return to the safety of the shore, it made a second bet, a more dangerous one. The twist, the clo pivot. Norinchukin realized they couldn't survive on 0% yields. So they pivoted from duration risk to credit risk. They didn't just go to cash. They reallocated capital aggressively into collateralized loan obligations, CLOs. What is a CLO? Think of it as a giant complex bucket filled with thousands of corporate loans. These aren't loans to Apple or Google, these are leveraged loans, debt used by private equity firms to buy out companies. By March 2025, CLOs represented a massive 20% of Norinchukin's market investment portfolio. We're talking about an exposure between 40 billion and 55 billion. Do you see the systemic trap? Japanese farmers are now the single largest funders of US corporate buyouts, the world's biggest private equity deals, the ones that decide if your company stays in business or gets gutted for parts, are currently being subsidized by a bank for fishermen in Tokyo. Norinchukin became the world's largest single buyer of AAA-rated CLO tranches. They effectively set the price for global corporate debt. But here is the silent assassin's endgame, the Nochu strike. The US leveraged loan market is now structurally dependent on Norinchukin's bid. If Norinchukin stops buying, the market for corporate buyouts freezes. If the market freezes, private equity firms can't refinance their debt. Corporate credit spreads explode. M&A activity dies. Analysts call this the no-chew strike. And why would they stop? Because the math has turned toxic. The mathematical reality, the hedging inversion. A Japanese institution doesn't just buy a US bond and walk away. They have to hedge the currency risk back to yen so a swinging dollar doesn't wipe them out. Follow the forensic trail of the math. As of late 2025, a 10-year US Treasury yields roughly 4.14%. But the cost to hedge that dollar exposure, driven by high US part short-term rates, is approximately 2.5%. That leaves a net hedged yield of just 1.64%. Now, look at Japan. Following the December 19 hike, the 10-year JGB yield has breached the 2.0% threshold. The choice is a mathematical certainty. Why would a Japanese LIFA or a whale like Norinchukin take a 1.64% return in a foreign country when they can earn a risk-free 2.05% at home? The 2.0% JGB yield is the event horizon. Once crossed, the sovereign magnet of Tokyo pulls every yen back to the mainland. As the whale swims home, it leaves a $3 trillion demand vacuum in the US Treasury market. The transmission. The Japan tax. This isn't just an institutional problem. It's a Main Street problem. Because Japanese whales were the primary buyers of US debt, their exit forces US bar. Yields higher to attract new buyers. This is the Japan tax. It's why US mortgage rates remained stuck at 6.3% in late 2025, even as the Federal Reserve tried to cut rates. The Fed controls the price of money, but Japan controls the cost of. The American housing market is currently in a deep freeze because a bank for farmers in Nihonbashi needed to save its own balance sheet. The whale has been beached. The Japanese lifers are retreating. Treasury market is shaking under the weight of a $3 trillion repatriation event. But don't think for a second that this is the bottom. The liquidity being drained from the system today is just the fuse. The explosive is much, much larger. The silent assassin has already moved past the banks and the housing market. It is now targeting the shadow banking system, an unregulated $80 trillion market that has no insurance, no backstops, and no way out. You cannot afford to miss what's coming next. Click here to watch video 1.4, The Shadow Bank Run. Because the detonator has already been pressed, and the shockwave is Chapter 7. Socio-economic transmission, Main Street. The silent assassin doesn't stay in the skyscrapers of Tokyo. It doesn't just haunt the dreams of hedge fund managers. It's coming for your house. It's coming for your local bank. And it's already inside the plumbing of the American economy. This is the Tokyo butterfly effect. A technocratic decision made in Nihonbashi is currently manifesting as a systemic shock across the American heartland. We call it the macro-micro bridge. For 30 years, you lived in a dream world subsidized by Japanese savings. But on December 19, 2025, that bridge was detonated. The victim, the American homeowner, and the Japan tax. Meet your first victim, the American homeowner. On December 10, 2025, the Federal Reserve cut interest rates to 3.5%, You were told relief was coming. You were told the lock-in effect would break and the housing market would breathe again. You were lied to. US. Mortgages don't track the Fed. They track the 10-year Treasury yield. And who is the largest foreign holder of those treasuries? Japan, sitting on a $1.1 trillion mountain of our debt. As the Japanese whales began their Great Repatriation, they stopped buying our bonds. They started selling. When the world's biggest buyer walks away, the price of debt collapses and yields skyrocket. This is the Japan tax. It is a structural surcharge on every American mortgage, paid because a bank in Tokyo decided to take its money home. The 2025 US housing deep freeze. Home sales volume has collapsed just 2.8%, levels not seen since the 1990s. Go check Zillow in your area right now. Is inventory sitting? Comment below if your local market is frozen. The American dream isn't just on hold. It's being held hostage by a 0.75% rate hike 5,000 miles away. The trap. The $160 billion regional bank vulnerability. The assassin has a second target, your local bank. While you're struggling with a 6.3% mortgage, the US regional banking system is walking on a $160 billion thin layer of ice. During the free money era, these regional banks took your deposits and locked them into long-dated treasuries and mortgage-backed securities bought when rates were near zero. They used a loophole called Hold to Maturity, HTM, which allows them to pretend those bonds are still worth 100 cents on the dollar as long as they don't sell them. But in the real world, the one where Japan is selling and yields are hitting 5.0%, those bonds are worth cents on the dollar. The aggregate capital gap is a staggering $160 billion vulnerability. This isn't just a banking glitch. It's a slow-burn credit crunch. When these regional banks see their capital eroding because the Japanese yield anchor has dissolved, they enter survival mode and stop lending to the small and medium enterprises, SMEs, that employ most of the country's other people. The silent assassin has moved from a Nihonbashi boardroom to an American bank vault. And finally, to the credit line of your local employer. This is the ultimate transmission. The silent assassin has moved from a Nihonbashi boardroom to a bank vault in America. The Fed has lost control over the cost of credit for the real economy. The era of exorbitant privilege is eroding. We are entering a new epoch of capital scarcity. But as the pain on Main Street intensifies, we are approaching the final constraint. What happens when the Bank of Japan realizes they can't keep hiking without bankrupting their own government? What happens when they hit the solvency paradox? Next, we enter the endgame. We look at the Hayes scenario, the moment the yen is sacrificed to save the state, and Bitcoin becomes the ultimate life raft. Stay with us. Act 4 starts now. ACT4, the Endgame. The silent assassin has already claimed its first victims. The whales are beached. The American homeowner is paying a Japan tax. But we are now moving beyond a simple market correction. We are entering the realm of systemic collapse. This is the phase of the investigation where the math becomes a predator. We call it the solvency paradox. In video 1.2, we looked at how office towers turned into ghosts, but in Act 4, we are looking at how a G7 nation turns into a ghost. Ask yourself, what happens when the world's most indebted nation finally decides to stop repressing interest rates You are about to see the exact moment the logic of the fiat currency system breaks. This is Fiscal Dominance. Chapter 8: The Solvency Paradox, Fiscal Dominance. Let's perform a forensic autopsy on the Japanese national balance sheet. The numbers aren't just high, they are mathematically impossible in a world of normal interest rates. Japan is currently carrying a gross debt to GDP ratio that exceeds 250%. For 30 years, this didn't matter. Why? Because the Bank of Japan was performing a miracle of monetary suspension. They kept interest rates at zero, effectively making a 1.1 quadrillion yen debt load free to service. The math. The death rate. But on December 19, 2025, that miracle died. When the BOJ hiked the policy rate to 0.75%, they didn't just move a decimal point. They shattered the equilibrium of the Japanese state. Follow the forensic trail of math. The Japanese Ministry of Finance, MOF, has just submitted a record request for the fiscal 2026 budget. 32.4 trillion yen, roughly $219 billion, just to service the interest and principal on their debt. Do you understand the weight of that number? 32.4 trillion yen. That's not just a number. It's a death sentence. 1 out of every 4 yen the Japanese government collects is now being burned just to stand still. That is 25% of the total national tax revenue gone. 1 out of every 4 yen collected from the Japanese public is now being incinerated just to keep the government's predators at bay. And this is just the beginning. Our projections show that if the BOJ continues its methodical march toward a terminal rate of 1.5% by 2027, the debt service costs won't just rise, they will explode. By fiscal 2028, the MOF forecasts that interest payments alone will surge from 10.5 trillion yen to 16.1 trillion yen. The total debt service will hit 35.3 trillion yen. This is the debt trap equation. When interest payments grow faster than tax revenue, a government must issue new debt simply to pay the interest on the old debt. This is the textbook definition of a Ponzi finance structure. The conflict, the Takeichi versus MOF war. Inside the Japanese government, a civil war has broken out. We call it the fiscal monetary pincer. On one side, you have the Ministry of Finance. These are the austerity hawks. They see the math. They know that if rates keep rising, the interest expense will crowd out every other part of the budget: defense, education, social security. They are desperate for fiscal consolidation. On the other side, you have Prime Minister Sanai Takaichi. Takaichi was elected on a platform of Abenomics 2.0. She is a populist. She knows the Japanese public is screaming about the weak yen tax on their food and fuel. To survive politically, she did something insane. In late 2025, while the BOJ was raising rates to cool the economy, Takaichi passed a massive 21.3 trillion yen stimulus package. This is the fiscal monetary pincer. The government is stepping on the gas, fiscal expansion, and the brakes, monetary tightening, at the exact same time. By issuing 21 trillion yen in new debt to fund the stimulus, Takaichi is driving bond yields even higher, which in turn makes the debt she just issued even more expensive to service. The conflict is irreconcilable. Either the government stops spending and triggers a depression, or the BOJ stops hiking and lets the currency die. The Hayes scenario. sacrificing the yen. This brings us to the end game, articulated by macro strategist Arthur Hayes. Hayes argues that the Bank of Japan will eventually hit a political ceiling. When interest payments threaten to consume 30% or 35% of the national budget, the government will stop worrying about inflation. They will start worrying about survival. The pivot in the Hayes scenario. The BOJ will be forced to abandon its normalization path. They will recognize that they cannot bankrupt the Ministry of Finance to prevent a total collapse of the JGB market and a sovereign default. The BOJ will pivot back to infinite quantitative easing. They will print whatever amount of yen is necessary to buy every bond the government issues. This is the moment of fiscal dominance. The central bank is no longer an independent guardian of the currency. It is a printing press for a bankrupt state. The result: yen to 200. The market will perceive this pivot as the final death of the yen's credibility. If you print infinite amounts of a currency to pay off infinite amounts of debt, that currency becomes worthless. This isn't moon talk. This is math. When a G7 currency enters a terminal print spiral, capital doesn't walk to the exit, it screams for it. Hayes predicts the yen collapses toward 200 per dollar. Your Japanese savings? Devalued. Your Japanese purchasing power? Obliterated. The life raft. Bitcoin to $1 million. But the yen won't fall alone. Because the global system is so interconnected, the death of the yen will trigger a contagion of doubt in every fiat currency, including the dollar. As investors flee the debasing yen, capital will flood into hard assets that cannot be printed by a trapped central bank. This is why Arthur Hayes projects that Bitcoin will hit $1 million. In this scenario, Bitcoin isn't a speculative tech stock. It is a digital life raft. It is the only asset with a fixed supply in a world where the world's third largest currency has just entered a terminal print spiral. The correlation of one we saw earlier, that was the short-term liquidity pain, but the Hayes scenario is the long-term solvency solution. The choice for Japan is simple, yet impossible. Save the state or save the yen. Based on the evidence of the Takaichi trade, we already know what they will choose. But how do you survive this new financial epoch? How do you position yourself for a world where the global liquidity floor has permanently risen and the yield anchor is gone? In our final act, we look at the strategy for 2026 to 2028. We show you how to future-proof your portfolio against the Great Reversal, because the era of free money is not just over. It is being structurally dismantled. Stay with us for Act 5, The New Epoch. The Life Raft. Bitcoin to $1 million. But the yen won't fall alone. Because the global system is so interconnected, the death of the yen will trigger a contagion of doubt in every fiat currency, including the dollar. As investors flee the debasing yen, capital will flood into hard assets that cannot be printed by a trapped central bank. This is why Arthur Hayes projects that Bitcoin will hit $1 million. In this scenario, Bitcoin isn't a speculative tech stock. It is a digital life raft. It is the only asset with a fixed supply in a world where the world's third largest currency has just entered a terminal print spiral. The correlation of one we saw earlier, that was the short-term liquidity pain, but the Hayes scenario is the long-term solvency solution. The choice for Japan is simple, yet impossible. Save the state or save the yen? Based on the evidence of the Takaichi trade, we already know what they will choose. But how do you survive this new financial epoch? How do you position yourself for a world where the global liquidity floor has permanently risen and the yield anchor is gone? In our final act, we look at the strategy for 2026 to 2028. We show you how to future-proof your portfolio against the great reversal. Because the era of free money is not just over, it is being structurally dismantled. Stay with us for Act 5, The New Epoch. Act 5, The New Epoch Time. The panic of 2025 wasn't a glitch, it was a demolition. The world you knew, the one where money was free, liquidity was infinite, and Japan was a dormant ATM for global risk, is gone. We have entered the new financial epoch. The Tokyo butterfly has finished its flight and the resulting tornado has reshaped the global landscape. This is the Great Reversal. For 30 years, Japan was the world's lender of last resort, exporting zero-cost savings that subsidized everything from your mortgage to the valuation of Nvidia. But the anchor has been dislodged. The exit is a narrow door, and the entire world is trying to squeeze through it at once. The question isn't whether the world will go back to normal. The question is, do you have the stomach for what normal looks like now? Because from 26 to 2078, capital isn't just expensive, it's a predator. Chapter 9. Future-proofing, 2026 to 2028. The forecast, the great convergence look at the horizon. We are witnessing the great convergence. For decades, the yield spread between the US and Japan was a canyon. In 2023, it was a massive 550 basis points. That canyon was the foundation of the global carry trade. But the canyon is closing. On one side, the US Federal Reserve is fighting a cooling economy, cutting rates toward a neutral 3.0%. On the other hand, the Bank of Japan is in the middle of a methodical march to 1.5%. The BOJ's cadence is relentless. Current Wall Street consensus and forward swap curves are pricing in a specific trajectory. June 2026, a projected hike to 1.00%. January 2027, the move to 1.25%. This is what the smart money is betting on. By 27, the spread will shrink from 550 basis points to just 150. When you adjust for inflation, the yields reach parity. The mathematical logic that funded the Western lifestyle for 30 years has been destroyed. Why is the BOJ doing this? Because they've re-estimated the neutral rate. They used to think the rate that neither stimulated nor restricted the economy was near zero. Now, estimates from the Japan Center for Economic Research and the BOJ's own staff place it between 1.0% and 2.5%. This means that even at a 1.0% interest rate, the BOJ is still stepping on the gas. They have a massive runway to keep hiking and they intend to use it. The yield anchor is gone. US Treasuries are no longer supported by a price-insensitive buyer from Tokyo. This is the permanent Japan tax on Western borrowing. The strategy, surviving capital scarcity. In this new epoch, liquidity is no longer a free commodity. It is a scarce, high-cost luxury. If you are still playing by the rules of 2021, you are a target. To survive 2026 and beyond, you have to understand the sovereign magnet. This acts as a form of passive quantitative tightening on the US economy. It doesn't matter what the Fed wants. Long-term yields are staying elevated because the Japanese whales are staying home. Rule number 1. Avoid the carry trade proxies. For years, currencies like the Mexican peso, MXN, and the Brazilian real, BRL, were the darlings of the market. They offered double-digit yields funded by cheap yen. But as the BOJ hikes, that carry buffer is evaporating. We are forecasting a sudden stop in capital inflows to the global south. When the yen strengthens, leveraged funds are forced to sell their pesos and reals to buy back the yen they owe. This creates a violent self-reinforcing loop of depreciation. If you're hunting for yield in Mexico or Brazil, you're picking up pennies in front of a global steamroller. Rule number 2, watch the US hold-to-maturity trap. The US regional banking system is walking on a thin layer of ice. These banks are still trapped with long-dated treasuries and mortgage-backed securities, MBS, that were bought when rates were low. As Japan sells our debt, the long end of the yield curve bear steepens. This is structurally bearish for banks. The aggregate capital gap for US regional banks is over $160 billion. As the 10-year yield pushes toward 5.0% because Japan isn't buying, these banks will see their unrealized losses explode again. Expect a slow burn credit crunch. Your local bank will protect its balance sheet by cutting off loans to small businesses and commercial real estate. The rotation, hard assets, and the end game. The ultimate constraint on this entire epoch is the insolvency of the Japanese state. Japan's debt-to-GDP ratio is 250%. At zero rates, that was manageable. At 1.5%, it is a catastrophe. By fiscal 2280, Japan's annual debt service costs will hit 35.3 trillion yen. That's $229 billion. Interest payments alone will consume nearly a third of the national budget. This is the debt service spiral. It crowds out defense. It crowds out social security. This leads us to the Hayes scenario. Macro strategist Arthur Hayes argues that the BOJ will eventually have to choose between saving the government or saving the yen. When interest payments become a terminal threat to the state, the BOJ will be forced into fiscal dominance. They will abandon the rate hikes. They will return to infinite money printing to monetize the debt and prevent a sovereign default. This is the moment the yen loses all credibility. Hayes predicts the yen will collapse toward 200 per dollar. When a G7 currency enters a hyperinflationary death spiral, capital doesn't just move, it flees. It flees into hard assets, assets that a trapped central bank cannot print. This is the rotation to gold and Bitcoin. In the Hayes scenario, Bitcoin isn't a tech stock, it is a digital life raft. If the BOJ sacrifices the yen to save the state, Bitcoin could hit $1 million, as it becomes the ultimate refuge for capital fleeing central bank debasement. Rule number 3. Embrace the correlation of one defense. In the short term, everything crashes together. Liquidity doesn't care about your long-term vision, but the solvency paradox creates a hard flaw. Gold and Bitcoin aren't bets anymore. They are the only things the central banks can't print into oblivion. A non-zero allocation to gold or Bitcoin is no longer a crypto bet. It is a rational defense against the eventual insolvency of the fiat system. Last words, The investigation is over. The verdict is in. The 30-year financial interregnum is dead. We spent 3 decades living on borrowed time and borrowed yen, subsidized by an architecture of repression that artificially suppressed the global cost of capital. But on December 19, 2025, the Bank of Japan pulled the structural anchor. The global liquidity floor has risen. The era of free money wasn't a law of nature, it was an anomaly. A 3-decade experiment in monetary suspension that has finally hit the wall of reality. You've seen the forensic evidence. The Japan tax is currently freezing the American housing market. The whales, like Norinchukin beaching themselves as the hedging inversion, makes foreign debt mathematically irrational. The correlation of 1, where your diversified portfolio becomes single, synchronized, dash for cash. This isn't just a market cycle. This is a regime change. The world's largest creditor has stopped exporting its savings to fund our deficits. They have activated the sovereign magnet and the capital is coming home. But do not mistake the symptom for the disease. The yen? The yen was just the fuse. The yen was just the fuse. The real explosive? The $80 trillion shadow banking system that was built on this free money machine. That system has no insurance, no backstop, and it's starting to smoke. We are talking about an $80 trillion blind spot in official statistics, hidden USD debt, FX swaps, synthetic leverage that doesn't appear on any traditional balance sheet. $39 trillion of that hidden debt is owed by non-Japanese banks, double their on-balance sheet obligations. This is the system that truly relied on that cheap, zero-cost yen liquidity. And here is the terrifying truth. The banks we talked about today have the Fed. The shadow banks have nothing. When they break, they don't get bailed out. They go to zero, no Federal Reserve backstop, no lender of last resort, no shock absorbers. When the liquidity in the plumbing freezes, the shadow banks don't just fail, the fuse is burning. The silent assassin is moving toward the dark corners of the global ledger. You cannot afford to miss what happens next. Click here to watch the Shadow Bank Run video 1.4. Because the system is about to find out exactly what happens when the free money machine stops and the invisible debt comes due. I'll see you there. Keep an eye on Macro Untold. Until then, be careful and stay sharp. Don't forget to hit the like button, drop your questions in the comments, and subscribe to Macro Untold. Also, turn on that notification bell so you don't miss our next videos.